Ajinkya, hi, good to have you with us. How have you been?
Good, good. I'm good. I'm doing good. How are you, Ashu? And wish you a very happy New Year.
Wish
Pleasure
you a
to
very
be here.
happy new year too, Ajinkya. And I'm doing well. COVID is back, trying to stay as indoors as possible, and I think that's a message that we have for everybody who's going to be watching this. Right, work from home, stay safe. On the outset, Ajinkya, this is an interesting session, right? And we're doing it right at New Year's, right? That's essentially the time when everybody's taking resolutions to kind of save more money, invest properly, be more consistent with pretty much all of their life and strategies around value creation, building wealth, all of that, right? I think the time couldn't have been better, right? In many forms and ways, right? I think you're doing some incredible work at Wint Wealth, right? You kind of democratizing investing and bringing debt possibilities or opportunities of investing in debt, corporate debt, for retail investors in many ways, right? Something which was not necessarily available in the form and way you were kind of empowering and enabling, right? Thus, this becomes a very important conversation, right? Democratization of investing is a very powerful theme, and especially for a country like India, where the cost of living, for example, is going up. You have to be very agile with the assets that you kind of invest in. Also, we are still a company, we're still a country which is grappling with trust issues when it comes to investing in equities, right? Something which is going away. It's a function of education. Debt becomes a very solid alternative, right? We've largely been dependent as a country on FDs, which are banking instruments. The ones that you are now bringing to the fore are different, of course, better than what FDs have to offer or banking instruments have to offer, and lesser risky when it comes to benchmarking it against equity as an instrument, right? So thus this becomes an important conversation in many forms and ways. Before we do that, I think a quick round of introduction would be helpful, right? Where we understand your motivation of doing Wilt Wealth, right? And where does it come from? So a quick round of introduction, and we dive into the session for the day.
Sure. So we started Wint Wealth. I mean, the idea was pretty simple. I mean, what I was working in fintech and lending domain, right? And I could see that these are a bunch of assets I would want to invest in, but
Right.
the ticket size was pretty high. I mean, 25 lakh, 50 lakh, and completely out of reach. And
Right.
right. So I started and I personally wanted to invest. We as founders all wanted to invest, right? And
Right.
we started digging. We realized, I mean, our first hunch was there must be somewhere we can buy this, right? But they weren't really available, right? So we started digging, talking to people more. Hey, why this is not available? So
Right.
one of the answers that actually infuriated me a lot is like people used to say retail investors are dumb, they are late to the party, and right, and they are not wise. These assets are too complex for them. They wouldn't
Right.
understand. And I believed, I mean, how much money you have doesn't like make you a best manager, right? How much
Right.
money you have, it doesn't mean that if you have more money, doesn't make you wiser,
Right.
it is about like managing money is completely different skill than having money. So
Right.
and we wanted to invest in this, and this seemed interesting, very hard problem to solve, so we jumped at it, and it happened very organically.
Very interesting. I think, yeah, I mean, when we talk of instruments, right? When we talk of debt instruments, right? Of course, you have bonds, you have bank FDs, but you also have instruments like FMP, right? And FMP are fixed maturity plans, right? Which are basically a portfolio of corporate debt, right? And FMPs have been available for the longest time, right? FMPs are usually better yield. They offer a better yield vis-a-vis FDs, right? And they've been advocated across banks, right? Uh, how are you differentiating yourself over FMPs, right? There you're getting a portfolio, which essentially means that the risk that you're possibly that could run within, say, a sector, a larger macro, is diversified much better, right? And of course, that happens at a certain cost. Uh, but FMPs have been there, right? How are you differentiating yourself vis-a-vis those instruments that have been there?
Sure. So FMPs have been there, but they are not better yielding products. They're better
Okay.
tax products, right?
Right.
So basically, they take indexation benefit, right?
Mhm.
So yield of the FMPs, if you see, most of them invest in PSU government debt bonds. So the yield is pretty similar to FD.
Right.
But because the taxation comes out to about 10%, so it becomes very interesting for HNIs especially.
Right.
So I guess FMPs are about 75,000 crore. It would have reduced recently, right? But
Sure.
these are all, majority of them will be in G6, government securities, right? Or PSU bonds. So credit risk is literally zero,
Mhm.
kind of products, right? Or close to zero.
Right.
The products we are bringing in are high yield, right? And we will bring also FMP like products where there is a tax arbitrage. So the value proposition of FMP is to provide tax arbitrage, you provide diversified set of like bonds, right? And we will go there eventually.
Right.
What we have started with, what we realize is like there are a bunch of good businesses which have like strong financial health,
Sure.
but are not rated AAA for some reason, and
Right.
that comes from. Let me explain this, right?
Sure.
So a rating, let's say a AAA rating, actually indicates the probability of default and not of credit loss.
Right.
That means if you have invested 100 rupees in a AAA paper, let's say, that means that entity defaulting on that 100 rupees is very, very low. It actually doesn't talk about or doesn't indicate anything about what happens if the entity defaults.
Right.
I, as a retail investor, am more interested in knowing like when my money is coming back, right?
Right.
Like assurity of money coming back is far more important for me. So let's say an unsecured bond issued by a AAA rated entity will be still rated like AAA, right? So, but if that entity defaults, I mean, we have seen like there are hardly anything that comes of unsecured bonds, right?
Right.
But let's say there is an A-rated entity, which the bond is secured. The underlying loans are also collateral backed, let's say gold loans or vehicle loans. For sure, the entity default, like probability of entity defaulting is much, like not much, but obviously higher than a AAA rated entity.
Right.
But even if the default happens, the money is more likely to come back, right? So these are arbitrages, or that's how like arbitrages in the rating system that we could see. And so that's the play we are creating. Saying these are A-rated NBFCs with superior health, better structured products. So the risk is higher, but it is mitigated well. And that's the value proposition we are bringing at Wint Wealth. Right? And obviously, we will build another layer of diversification of tax arbitrage on top of these bonds, right? So this is where we have started. But eventually, we will bring in FMPs, which gives you tax arbitrage, diversified portfolio, plus like, we will also, we anyway provide secondary liquidity. We help provide secondary liquidity.
Interesting. I think when we talk of FMPs, right, and you know there are a variety of FMPs, right. So if you're talking specifically for a short-term FMP, right, which is a 14-day product or a 30-day product, right. That's essentially when you're talking about GSECs, right. But when you're talking about long-term FMPs, there are like 5-month FMPs, there are 9-month FMPs, there are 14-month FMPs also, right. And they are essentially, the construct is that you have a lot of CDs, right, corporate debt papers, which are within them, and there could be NBFCs as well, right. Now, what we've experienced in the past, right. I mean, we've been as a country across a very turbulent time, right. I mean, if you really look at how things have been, right? There's been a liquidity crisis. We went through demonetization. Corona has hit us in a very difficult way, right? There was absolute liquidity crisis, right? That we've experienced last 5, 6, 7 years, right? Now, what has happened is that a lot of CDs, while they've been AAA rated, right, a lot of them actually went on for rollovers. Right, and that's largely because the entire system that they built, right, of basically revenues, collection, so on and so forth, kind of collapsed in the process, right? We're still very, very fragile. We've also gone through a tax structure transformation, right, which is very good in long term, but it's been painful, right? The transition has been very ad hoc at many levels, and this is something which is out there. A lot of senior economists have made comments around the implementation of GST, right? For example, what happens in an environment like that, right? Is this, I mean, while of course we understand that these are AAA rated papers, right? There are still macroeconomic risks that are there, right? Which a lot of these entities could be subject to. What happens in an environment like that to a CD which a retail investor is investing in, right? Where, like you said, right, the priority of investing is to invest in, the visibility of money coming back is much higher vis-a-vis the returns that they're making, right? I mean, they're essentially an averse society, right? How do you break that down, right? Given that this must be a very critical area of focus for you. How do you factor all of these movements in, right, which are more systemic in nature?
Sure. So I think if you look at the data, right, the AAA's entity that have like rollers are still macroeconomic scenario. I think retail investors would be more concerned from as long as the money is going to come back, they are still fine. Obviously, there is always some sort of discomfort if things are getting changed, right? But what like I mainly more worry about the fraud risk, right? So if you have seen the AAA businesses that have gone down, like let's say ILFS or let's say DHFL, those were the fraud risks that which actually played out, right? So if a business is rated AAA, I mean, it's highly unlikely that it will collapse because of macroeconomic factor. I mean, obviously it is not zero, but that probability is pretty low.
Sure.
What is more actual probability, or what is more realistic scenario, and especially in India, is corporate governance issues, right? So, and the fraud risk increases, and like the book size becomes so large that like nobody really has a clean view on the operating business, and that creates opportunity for somebody to cook books, and eventually that collapses. So I'm not really worried on microeconomic things, because rating and all actually do take into effect of that. So and entities are like agile enough to actually wade through that crisis. The lenders are supportive, which if the business is fundamentally doing good, the lenders will back the business, right? And most of the defaults that we have seen, I mean, especially AAA rated, right? Obviously, once you go down the curve, BBB rated, I mean, they will, a macroeconomic scenario can cause harm to them, right? But AAA rated, it's all fraud risk that we've seen playing out.
Interesting. I think what will be interesting is because there are you've kind of broken it down, right? You've unitized in a phenomenal way, right? Where somebody can come in and actually kind of check off 10,000 rupees and still be a part of it, right? And I think that in itself, that strategy of diversification also kind of solves for this particular problem that we kind of discussed, right, in our earlier question. I think what will be interesting is, for the interest of many people who are going to watch this, right, if you could run us through the process in that you, for example, have designed to do this, right? I think that'll be very helpful to basically build an understanding of the offering better. So yeah.
Yeah, no, I'll first tell you how we look at it and from a very abstract point of view, and then we'll get into detail, right? So what we're essentially doing is we are not underwriting AAA rated business, because there is no yield, right? The yield is 5.5. So retail investors better park their money in FDs, right? So we are basically focusing on a category of businesses, right? So and there are some arbitrages that we are looking into, right? So what we are essentially underwriting is their cash flows.
Right.
So what we are saying, okay, there is a possibility that this business can go bankrupt. But what happens when that business goes bankrupt? Do I have something to rely on and something to, something from which I can recover our money?
Right.
And the first set of businesses we are catering to are NBFCs. So NBFCs have given these retail loans out, right? Whether it is personal loan, gold loan, vehicle loan, property loan, etc. Right? And these are committed receivables for those NBFCs. So we are basically underwriting not just the NBFC, but also those receivables.
Okay.
If anything were to happen to the NBFC, we will take our money from the underwriting collateral.
Interesting.
So that's how we are kind of mitigating.
Securing yourself, right?
So now, but still, our primary focus is to make sure that these NBFCs don't go bust, right? If everything works well, we don't have any headache.
Right.
So as I mentioned, right, these NBFCs are low leverage, right? So in India, I mean, and this is all rating arbitrage, and these are gaps in the rating infrastructure or rating philosophy per se.
Right.
So let's say a business has 1,000 crore equity, right? And it has a loan of, let's say, 100 crore, right?
Right.
So the portfolio has to be 90% NPA for lender to actually lose money.
Right.
Right. And these loans are secured. But this business will be still rated A. Right? Because like in India, rating downgraded is something that nobody wants, right?
Right.
So rating agencies are very slow to upgrade these businesses. Right. So we look at businesses where there is large equity and lower leverage. So they have a lot of equity in the business, but there is not enough debt. Right. And that's where we come in. So that reduces the bankruptcy risk by magnitude. So lower leverage is what we look in the NBFC. Second, are their lending profile drivers enough? Right? So are these diversified enough so that if they pass through some cycle or something, there are enough people supporting it? I mentioned that lenders are very supportive if the promoter is doing right thing, right? And everybody understands there are business cycles, right? So diversified lending profile, that's what we look for, right? And third, as I mentioned, corporate governance, right, is a big issue. So we don't work with just promoter-driven NBFC. One of our biggest criteria of selecting NBFC is what kind of PE investors they have. They have to have external investors.
Right.
When a PE investor comes in, they generally take a seat on board. So they look after corporate governance. They change the auditor to one of the big four or somebody really reputed, right? So the probability of somebody cooking books reduces very drastically.
Right.
And P investor coming in also provides additional equity comfort.
Right.
So when COVID happened, many NBFCs got double down on their equity, raised equity from their existing investors,
right.
Just to give comfort to lenders. Right. If they
Right.
didn't have P investor in a time of crisis, no external investor is going to come in and write your
Right.
equity check. Right. So these are three NBFC level factors. On the portfolio level, we do individual loan checking, right? So we have detailed tech pipes. So if it is a vehicle loan, we will check whether the vehicle number, engine number, and chassis number is matching with the borrower name.
Interesting.
Whether the vehicle is hypothecated to the same NBFC, whether it is the same borrower that is mentioned by the NBFC.
Right.
We will be soon integrating bureaus, CIBIL pipes, etc. Right.
Right.
So if it is a vehicle, if it's a property loan, then we check if the property is legal clear, whether the property is hypothecated, whether it belongs to the same person, whether the valuation is, and we have our independent valuation mechanisms in place. So a lot of technology stack has been built to underwrite these loans real time. Right? So that's how we mitigate risk, right? In a broad sense.
That's very interesting, Ajinkya. But this is all a very, very time-taking process. I think there are two things that I kind of understand from what you're saying, right? One is you're not necessarily relying on a credit rating agency, right, or the rating and ranking that they've done, and that's largely because they're possibly slow. That the structures are two-dimensional. They're not really factoring in a lot of other risks that possibly exist, right? And I think as an economy, as we're kind of growing, there are new risks that are coming up, and we'll talk about that as we go along, right? But you're saying that that's not what you're purely relying on, right? You have your own stack in place, which you're now kind of you're fusing the two together, and then essentially making these extending these or participating in the series, right, that are getting issued. But Ajinkya, doesn't that slow down the process, right? Doesn't that slow down the process for you? Because and the other thing is the comfort or discomfort of the NBFC, right? Because my sense is the rounds that they're raising, right, and this is are much larger, right? You still got to be just participating in 10-15%, and I could be wrong on this one. You could correct me. Of the round that they are sort of raising, right? Are they comfortable to make all of this information available, right? Because that's what they've fed on for the longest time, right? They've not been very open to giving out all of these details. What you were talking about is going piece by piece, file by file, right? A lot of that due diligence, right? Which they've never been subject to.
Yeah, no. So one thing another thing I didn't mention is we do a thorough diligence on the NBFC. So it is a 6-week process. So we actually visit a lot of NBFC branches, go through NBFC's processes, not just the portfolio, but any random portfolio, and we do a lot of random checking. NBFCs are open to sharing that data if they see value. The biggest value we provide to these NBFCs is a diversified source of capital. Right? So today they might have 10, 20 banks, but these all banks have same cycle of capital.
Right.
Any macro event happens and all banks go backward on the funding, right? Or they start. So they are looking for a diversified source of capital. Right? So we help them unlock that retail capital. They neither have ambition or strength or skill set to raise capital from retail. Third, there is a lot of intangible benefit that they get from raising money through retail.
Right.
These all NBFCs are like private equity investors funded, right? So they have ambitions of going to IPO 2 years, 5 years, 7 years down the line.
Right.
And if they raise money from retail and deliver that return, the kind of brand building that happens wouldn't happen otherwise by spending any amount of money. Right? So they are more than open to share that data. We don't see any problem. On things getting slow, yeah, that's obviously true. But like what we are very clear is we cannot compromise the quality of underwriting just to go fast. Right? This is a long-term business that we are building. So it generally takes about 2 months to onboard. Subsequent things happen easily. So we are doubling down on the team, technology, and making sure that the stat can be reduced. But we will only do it with making sure that the quality doesn't go down. Right?
Very interesting. I still have a bunch of questions on the COVID, right, and the risks that, for example, is come in the overall macroeconomic scenario, right, which essentially means that the behavior of most financing institutions is going to be very different, right? But before I come to that, what I would love to understand, Ajinkya, is the process, for example, of engagement of a retail investor, right? Because you're breaking it down. So are you? So what's the process of it, right? Are these NBFCs issuing bonds which you are buying and then further selling to retail investors? Or are you essentially a platform which is enabling this matchmaking of sorts, right? I would love to understand that respect, I mean, that side of the enablement that you're doing?
Yeah, sure. So what we additionally also do is we help these NBFCs get these bond rated. We also help
Right.
them in listing, and so most of the coming issues are public issues, right? So these will so people can apply it directly.
Mm-hmm.
So we don't have to buy them and then resell to investors. We have done that in the past, but since the regulatory change, the regulation made it possible for these smaller NBFCs to do public issues. So
Right.
these are publicly issued debt products that
Mm-hmm.
that are and retail investors can come to our website and subscribe to them. We
Right.
also another big part of our work is educating the retail investor about it. This is a completely new asset class, right? And especially what we have seen in India, it is a very low trust country. Because
Right.
people have seen, people have been scammed, people have been
Right.
told, right, people have been pushed wrong products down their throat by by uncles who sell different policies
Yeah,
and
totally.
bank accounts, right? So, and what I personally fundamentally believe is, if it's an investment product, risk is part of the product, right? That's
Right.
why you're getting higher return. Right? It
Right.
cannot be something that is in fine print disclosure, something that you run at 2x, 3x speed, right? It
Right.
should be prominent, right? So, we do a lot of education around risk, a lot of nudges to make sure that people understand. In fact, in our product flow, there are three nudges that people have to read and then go forward, right? So
Right.
a lot of part is around education and mainly around risk, right? So people understand the risk that they are taking.
But tell me this, right? I mean, irrespective, I think we're still a country. I mean, the fascination of stock market is relatively new, right? I mean, until COVID hit us, right? Just about 3% of savings was going into stock markets or equities and instrument, right? Primary, secondary, all put together, right? All of a sudden, people had time and they were, at home, and they said, and the stock market fortunately has been doing much better, right? And they kind of, we kind of saw the growth almost quadrupling the number of accounts that was there. But we're still an economy which doesn't necessarily understand risks that associated with this, right? I mean, many of our investors are a product of bull run,
Yeah.
right? They haven't seen that, right? uh, do they really understand the risk that is associated, that comes with, say, a structure like the one you're offering, right? uh, or are you only targeting a certain select profile, right? That ABCD should be there, that is a foundation that you will look at for anybody to come in and participate, right? Is that how you also sort of managing it, or uh, it's too difficult to calibrate, right? In an environment like India, because we operate at many levels. We're a fairly complex economy, right? And education, one-way education, only becomes the option in the process.
Yeah, no, I don't fundamentally agree that they are not able to appreciate the risk or understand the risk. You have
Sure.
to do a sound effort of putting that, making sure that they understand.
Right.
Uh, like most of the investors who have invested on the Wint platform, I don't think that they will be able to explain the risk in a very technical sense, but
Right.
they would definitely understand the risk in a very practical sense.
Sure.
In what scenarios my money is going to be stuck, in what scenarios my money is going to be lost, right? And
Right.
how much and what is, and they might have a different sense, and they might have different uh, probabilistic odd assigned to these scenarios, and
Right.
that's very individualistic, but they do understand, and that's the kind of practical risk, right? People should understand, right? Like if you are coming
Interesting.
in equity market, you should know that realistically there can be any time where there will be 30-40% drawdown. If
Right.
people don't know this, they don't need to know how the stock fall or anything. They don't need to be expert at
Right.
understanding of the risk, but they should appreciate the real risk or how it will impact their lives, right? And
Right.
that we are doing very much from our capacity. And
And
investors are open to know it. They want to know more, and like a lot of investors spend time understanding the risk. It's just that we haven't been we have been accustomed to people where if you are coming and selling me investment product, it's my job to find out risk. You
right.
will always hide risk, right? We want to
Right.
change this. We have changed it. We're saying if you are like coming on Wint Wealth and investing through the platform, we will make sure that we disclose the risk like nobody else. You can simply trust on us, saying we were telling you all the risk. And obviously, people have been investing less because of that, and we are pretty happy of that. So it is actually correlating with data.
Interesting. Ajinkya, one thing that I want to understand, right? I actually want to understand, what are the channels of acquisition that have really done for you well. But before I do that, I want to understand more on the regulatory side of it, right? Now, typically, when you are a platform which is enabling any kind of investment, right? Be it debt, primary, secondary, whatever, right? There are agencies that you have to have approvals from, right? AIF is a category that has been established to doing all of that, right? Are you at Wint Wealth subject to any of that, or are you essentially, because you're a tech platform, there's a gray area around it, right? And that does not necessarily gets captured in the AIF structure, which has been designed, right? How are you navigating on the statutory guidelines around enabling this investment?
Sure. So, AIF, the minimum investment is about 1 crore per investor. So that's completely out of retail investors, right?
Sure.
So we are getting these bonds listed and publicly issued on exchange, right?
Mm-hmm.
And we being tech platform, we don't really need any license.
Okay.
For doing a public issue, there has to be a merchant banker. So there
Right.
are merchant bankers involved in the process. We have also applied for our own merchant banking license, and we would get that soon.
Mm-hmm.
And that was mainly from the point that we get better access to the information.
Sure.
We get legal, we kind of have a locus standi in the whole transaction.
Right.
And right now we don't need any license. There has to be a merchant banker involved, and there are some merchant bankers we work.
Interesting. Ajinkya, customer acquisition, right? Now, we've touched upon this, right? And you kind of highlighted, right? But that's the most difficult part of, I think, any business where you are, out there to convince people to invest in a certain asset class, right? And this is a relatively new asset class, which requires a lot of communication to sort of happen, right? Mutual fund sahi has been there for donkeys of years, right? And still we've grappled with the kind of issues that we have. But how's acquisition played out for you? Which are the channels that have, for example, worked out the best for you? Right. And more importantly, I would love to understand the demographic. I mean, we've touched upon it, but I'd love to understand, what is it that you are seeing in your, for example, the participation that you're seeing, right? What is the demographic which is coming in and participating, right? I'd love to understand that, and possibly the risk profiling mechanism, right? I mean, for example, when you are enabling investment, risk profiling becomes important, right? Is this something which is happening, or is there a disclaimer saying that, listen, this is an asset class which is subject to investment, and they are taking a decision in their independent capacities, right? Of what happens, right? Is there handholding which is happening? Would love to understand that.
Sure. So for acquisition, a lot of traffic comes to from my LinkedIn handle. So I write about personal finance on LinkedIn. I was also recognized as LinkedIn top voice last year. We have about 50,000-60,000 followers there. And a lot of traffic comes from there. Second, a lot of traffic has been coming from referral. Investment is a very social product.
Right.
Before investing, people ask their friend, hey, should I invest there? What do you think? And after investing, they will go and tell, hey, you invested this.
Right.
Invested here, please check this out, right? So a lot of, and third, some of the traffic is also coming from influencers across different social media platforms, right? That's on the acquisition side. On the risk side, obviously, I mean, people have to take their individual decisions, right? But what we are fundamentally looking at risk differently is you need to explain the practical risk to people, right? Mm-hmm. It is very easy to say that, hey, these are subject to market risk and blah, blah, blah. Right. What does that mean for investor? Like, how does he supposed to he's not someone who is PhD in economics or something. Right. So you need to simplify that, and we are able to simplify that, and we have made it very prominent. In fact, before investing, you have to sign 3 banners, or let's say, I understand this. There are 3 places where you can't go forward without actually looking through it, and we have made it simple. We have brought in a lot of video content around it. Right. And that has been helping. People have been appreciating the practical risk, right? Now on the demographic part, we've been targeting, let's say, 25 to 40 year kind of people, right? And these are mainly from tier 1 cities, but we have seen a lot of traffic coming in for tier 2, tier 3 cities. Interesting. And a lot of elderly people coming in, and so we actively discourage them. We are bringing a better product for them soon, right? Interesting. And some of the students are also coming in, but COVID has fundamentally changed it, right? So these are people who basically, what we realize, the core trait here is they are fundamentally able to trust something digitally, right? They are digital first people. In traditional, if you go back 15, 20 years, people used to trust a bank by looking at its physical branch. Right. Today, they don't need to see that physical branch. And that's the kind of crowd we are attracting on a very fundamental way.
Interesting. Interesting. But tell me this, right? And a fun question actually, Ajinkya, right? I mean, the generation that you're talking about today, right? Especially the students and and the first time, people who picked up jobs, right? Have that disposable capital, liquid capital, right? As looking at stocks, flirting with crypto, right? And I think that's the new word, right? Do you still consider yourself to be sexy option? Right? I mean, because the kind of returns that people are seeing, the kind of communication which is happening, and the kind of aura that is kind of now being built around equities, and the kind of rush that we've seen is phenomenal, right? Don't you think it's a challenge to keep sanity on, right, for these investors, that this is an asset class which has been done more responsibly, right? Which is going to give you better returns than an FD. This is not equity, right? What's your take on that?
No, it's not sexy. I mean, and we don't want to be sexy. So we are building something very serious.
Right.
And what we realize, I mean, it's not our job to convince people that 10% is great, or 9% is great, or these assets are great. Our job is to basically bring out these assets for people who already appreciate these kind of products, and
Right.
that's a large janta out there.
Right.
So you mentioned like a lot of people come in bull market, right? And these are followed by horror stories of they losing a lot of saving and burning their hands, and then they are ripe for product like ours, right? So
Right.
I don't think somebody coming in with a 18% expectation, you can convince him that you should allocate some part of it to 10%. I mean, people like I've met some investors. In fact, there is kind of a divergence that is happening. So people are saying if you want to go fix retail product, like then we'll go for product like Wint or FDs or something.
Right.
Or if you want higher risk, higher return, we'll go into crypto. I know like some of the people who are not at all present in equity.
Right.
So people are saying if I'm going higher risk, uh, then I'll go completely higher risk and completely play lower risk. So this middle band is missing. Eventually, I mean these are very common behaviors in bull market.
You're an instrument for married men and married people, is it?
Yes, yes. So and these are very common behaviors in bull market,
Right.
right? And like eventually market like sanity comes back sooner or later, and
Right.
people learn their lessons, right? And they move on, and they become better investors.
I think I how I wish we can avoid the pain that comes with with downturns, right? Because bull runs build a very different kind of an expectation, right? I think that reality check and that sensibility has to be kind of built in much faster, right? I think and like I said, right, I think if you can avoid this pain in any form and way, I think that's just so much more important. uh, Ajinkya, I'm going to move to I want to actually discuss a COVID specific piece with you, right? But before I do that, I'd love to understand how is tier two and tier three performing for you, right? Is there an unexpected participation that you're seeing, something that you never kind of anticipated, but there are people who are waking up to it and want to sort of experiment, right? Maybe this is not a large part of their portfolios out there, but they've still started to do that, right? Are there trends that you're seeing in that front? Because uh, tier two for some reason has become very, very exciting, right? I think we've become a very homogeneous market post COVID, right? We're essentially consuming for just about 4 5 screens, and that eases the ability to communicate better, right? And for them to understand and question back and all of that, right? So the medium has become very transparent. What are the trends that you're seeing from tier two and tier three markets?
No, I mean, we are seeing a lot of traffic coming in from tier two, tier three market, which fundamentally isn't actually different than tier one market, right? So,
Okay.
and like I said, right, COVID has made everyone digital first, right? Whoever you are, you had to go digital, whether you
Right.
wanted to take a vaccine, whether you wanted to order groceries, vegetable, and whatnot, right?
Right.
And if you look at earlier, what used to happen is if you're in Bangalore or Mumbai, you'll see a lot of new products coming in. So
Right.
your propensity to test these products is higher,
Right.
and like that will go to tier two, tier three towns later in the life cycle of a product.
Mm-hmm.
Today, everything like when somebody pushes a video on YouTube, or if I push an article on LinkedIn, it reaches to the same, like whether a person is
Correct.
in Bangalore or in Jalna or somewhere, right? It reaches at the same time. And why I mentioned Jalna, one of the very early investor of Wind came in, not I guess first among first 300 or 400 investor. One of them was a doctor from a tier three, tier four kind of town called Jalna.
Interesting.
And I couldn't have imagined any way that it would have happened before COVID. However, money,
Interesting.
whatever channel we would have done, right? And this used to happen earlier when people used to see a product on TV screen, right? So a lot of advertisement used to generate awareness about these products in tier 2, tier 3 towns. Now, and for product to actually advertise on TV, it has to become a lot bigger.
Right.
And that's why we used to see that lag. Today, there is no lag because YouTube, Instagram and Facebook and, LinkedIn, etc.
I think, and I think the other thing is that people have, for some reason, become a little more confident, right? I think that inhibition is in a way gone, right? And I think, also the fact that the size of investment possibilities become smaller, thus the ability to come in and experiment, I think, is increased, right? And I think given that people are essentially all home, that the investable capital kind of increased, right? And I think that's kind of moved, right? And I think that's also being the same in tier 1 and across tier 2 as well, right? And plus, communication has become just so much more, like you said, right? The arbitrage that existed, right? The physical arbitrage that existed has kind of now reduced. People have more time, right? And I think that's essentially what is doing it. I think I want to move to a slightly more important question, right? This is more a macroeconomic question. Now, what COVID has done is, of course, while there is this entire exuberance that we have, right, in the market, there's a lot of liquidity flow, which we've seen, right? Global liquidity flow, domestic liquidity flow, right? And because this availability, which is now going into asset classes, which is of a variety, right? New asset classes are kind of now emerging. But we still, as an economy, kind of transitioning, right? What that essentially means is that there are newer channels of, for example, say distribution that are getting established. There are newer ways of business that are getting established. Which what that essentially means is that a lot of, for example, large enterprises, are going to change shape, right? How lending, for example, happens in the market is going to change shape completely, right? Ownership of assets is going to change shape, right? And all of this, while of course it used to be very theoretical, before 2020, a lot of this is now becoming very real. D2C, for example, is becoming large, right? We have a bunch of brands which have become a unicorn in a shortest possible time, right? Which are going to be competing with the Hindustan levers of the market and so on and so forth, right? So what essentially is going to happen is, because there's this huge shift which is happening, there's a new emerging complexity which does not necessarily has a very clearly defined shape. What that possibly is going to do is that gig, for example, is going to become big, right? Now, my sense is, I think we are headed into an ecosystem which is going to be very complex, which is not necessarily going to have a very clear shape design, which means that the risks that we've kind of talked about, right, which became predictable because there were practices and there was methodology and a system that were created, is going to take a very different kind of a shape, right? And that could hamper the ability or inability to lend and then to recover, right? Because of these inconsistencies that are going to emerge, right? How are you looking at all of that, right? Because this is very, very real, right? You are in a way directly participating in the risks of these, say, the NBFCs that you're working with, or for example, other large rated assets that are available. You could potentially look to take stands in, right? How are you factoring all of that? I know there are no clear answers to this, right? But what I want to understand is how you approaching this, this shift in paradigm that we see.
Yeah, some general observation that we've seen is that businesses are at a bigger risk, right, of existence. They have to be agile, and it's very difficult because when a fundamental shift happens, for them to adopt and let go of their margin flows, etc. But individuals, if you look at all this shift, it is actually making market more efficient, right? And it is actually benefiting the individuals, right? The kind of salary hikes we are seeing, those are not abnormalities. Those were gaps, structural gaps in the market that suddenly got patched due to digitization or etc.
Okay.
So the market has been great for individual people, like if you, whether it is a gig economy or salaried people or like anyone who is in formal economy, right? So a lot of people or people who are getting into formal economy, all these shifts have been very helpful for them, making them lot stable. Like a lot of insurance is coming in. So individual underwriting is becoming more and more easier, like easier than before. But business underwriting is going to be tougher, right?
Right.
So for us, we primarily underwrite a business, but the underlying portfolios are always individual loans, right? So and we are careful to adopt to these, right? And we are fairly new, right, on the street. So
right.
It's very easy for us to adopt. There is no bureaucracy in the system yet.
Right.
It has been a great time for us because this kind of environment basically is favorable for new kind of entrants, right?
Very interesting. I think, well, of course, and an interesting point that you highlighted, right? That you're in a fairly early stage, right? Distribution is something which is very, very important to you, right? For example, right now, a lot of movement which you're kind of seeing is essentially because of the influencer status that you, as a leader in the team, has kind of had, right? Uh, Going forward, what's the plan, right? I mean, are you gonna also look at traditional methods of distribution, for example, say banking partnerships and so on and so forth? What's happening on that front, right? Because my sense is, I think this is a game of land grab, right? While of course you're doing what you're doing on the underwriting front, but you would want to acquire as many people, right? So one, of course, what are the current numbers? If you can share some of, I mean, if you can give a view of that, and what are the next, what are the targets that you've set for yourself, right? Would love to understand that.
Sure. So we have about 10,000 plus transacting investors on the platform. Another
Interesting.
60,000 are there on the wait list.
Okay.
150 crore is invested through the platform.
Interesting.
We don't really keep targets because once you keep targets, then you start aligning to that, and then you try to push people down the line, right? Our target is to get right set of these retail investors and keep growing, right? Not the AUM. AUM is not the target, right?
Right.
In terms of like different distribution channel, we will definitely explore different channel. I'm not really bullish on going through banks and these kind of mechanism. One is they're very bureaucratic.
Right.
Second, we have repeatedly seen it again and again. Like there's not a specific comment to any channel that's it, but they prioritize their own good over the investor good, right?
Right.
And that eventually will lead to a lot of mis-selling, which we can't tolerate simply, right? As an
Right.
organization. So focus has been different, will be different B2C channels, and we are building team and experimenting a lot around different growth channels.
Interesting. You mentioned of before I come to the distribution point once again, right? Would love to understand more about the wait list, right? Which you kind of alluded to, that there are about 60,000 people who are on the wait list, right? Why the wait list, right? Are there it's because you kind of building those opportunities, identifying those opportunities, and there is a certain lag there. Is that the reason, or for example, say profiling becomes important, right, in the entire scheme of things, that you have an aware set of investors who are coming in, right? So where is the lag? Where's the wait?
Yeah, no, it is on the supply side. I mean, because
Interesting.
we are very careful in underwriting and bringing the right opportunities. So as soon as the opportunities come, they get over. So our last asset of 50 crore got sold out in 4 hours, right?
Wow.
But we want to make sure that just because there is demand, we don't bring crappy supply, crappy assets. So
Right.
We want to stick to it. We should solve that problem. We have been doubling down on team technology for solving for supply. We should solve that soon. So, but people who couldn't invest basically get onto the wait list for the next asset, or they can, if somebody wants to exit from the earlier assets, they can invest in those assets. But it is more of a supply constraint than.
Interesting. But Ajinkya, what's the average participation price? I mean, average participation value. If you could give me a broader number. I mean, I know there are certain specifics that you possibly cannot dole out, but would love to understand in a broader.
No, the average investment is about 1.4 lakhs per investor.
Very interesting.
Across assets. I mean, it could be one asset or multiple assets.
But I'm saying that's per individual is what you're kind of talking about.
Yes.
Very interesting. That's amazing. Ajinkya, typically when you talk of a financial or basically an asset driven business, right? Margins are essentially something which is the most questioned piece, right? And you kind of alluded to that point, right? That not choosing a traditional distribution channel is a call that you're taking, largely because the interest is very different, right? It's possibly short term in many ways, right? And mis-selling happens, and a lot of that happens, right? What are the kind of margins that you operate in broadly, right? I would love to understand that, because in any case, we're talking about a debt instrument, right? Cost of capital becomes very, very critical in that scheme of things, right? Does that leaves you with enough margins? What are the kind of margins that you possibly operate with, right? Or are there the margins look better because now you are also looking at merchant banking activity, right? With a lot of these players. How does that play out?
Sure, we make about 1.5% yearly basis on the money invested, right? So those are the kind of margins which are pretty healthy, right? And we like some of the assets we have made, we have made more, some of the assets we have made less. But on steady state, it will be in the range of 1.5% is what we imagine.
Interesting. Any efforts to increase that? Because there's always a temptation, right, to do that. But I think anything that you're doing to sort of improve those margins.
Here we are actually running a couple of experiments, but those are very early stages. I mean, those experiments we would have run without, even if that didn't increase the margin. We think that we could create potentially a better product for investors. But they will also end up making our margins little higher. But we don't see we wouldn't make more than 1.52% in long run. Even if we can, we will pass it on to retail investors.
So is there a correct is this a fair understanding that you essentially the structure that you've kind of adopted of is that of an AMC, right? And I think you'll continue to, I mean, the foundation becomes to continue to have great quality assets on one side, and then have the investors to come in and participate, right? And eventually sort of AUM becomes your a very or the top of the line metric, right? And that's how you kind of get evaluated. Is that how you're kind of driving it? Because I think my sense is, sitting here, my sense is I think there's a lot more that you're doing, right? I mean, you're literally, the kind of dynamic times that we are in, right? Your role is much deeper, right? But when I start looking at the numbers, it seems that of an AMC, right? Is that a fair understanding?
Probably 10 years down the line, not now. Not currently. All the idea is to grow investor base, because
Right.
as we grow the investor base, build trust, we can bring on many different product asset classes themselves, right? And that will increase the AUM. But yeah, eventually it will be kind of a AUM like. But that is never going to be a North Star metrics. Our North Star metrics is always going to be how many investors and what is the NPS that we have with them, because
Interesting.
AUM will be always a lagging indicator, and like we don't want to really work on reducing that lag, because as long as the customer love is coming, customer is being is happy, the money will come in sooner or later. We don't need to worry much about it.
Interesting. And I think,
What is
please go
very
ahead, sir.
important is we serve the customer well today and not look. In fact, there are many cases where like people have invested in, like too much amount into one bond, and we've reached out to them and told, hey, probably it is wise to withdraw some of the money, and we've made them withdraw.
Right. Interesting, and that's possibly and I think you're kind of approaching this with a little more responsibility, right? Because possibly it's a new asset class. I think there is a name that needs to be built, and it's not a short-term game, right? I think India is a market which needs that kind of plowing, right?
Absolutely, absolutely.
I think we're a sensitive economy in many ways, and when it comes to money, we're all the more.
Yeah, I think more than responsibility, I think I just want to sleep well, right? Thinking that I did my job well and nothing is on my conscience, right? So I think it boils down to that as a founder, right? So it is not a business centric decision that it's more of a value driven decision, saying we don't want to miss sell at all at any cost.
Interesting. That's phenomenal. I think towards the end of our conversation, right? What are the next 2 years like? I would love to ask you a 5-year question, and it's this entire question is becoming cliched by the end of it, right? I mean, I think every founder that I've spoken with, I've asked this question, right? But what are the next 2 years like? What are the next 2.5 years like, right? What do we see you do on the supply side, right? Because, like I said, right, there's going to be a lot of churn that we're going to see. There is a lot of the newer world models are becoming so much more prominent, right? Supply will be a little, it possibly is not going to be as predictable, right? So you'll have to have better risk measurements, right, in place. A lot of that is going to happen, right? What are the next 2 years like, right? What do we see you achieve?
No, I think we are not really worried on the supply. Our supply is more of streamlined. We need to double down on what we are doing. We are focusing more on the product innovation from a tax arbitrage point of view, from a diversified point of view, right? And making sure retail investors understand it well and bringing more asset classes, etc. I think that's going to be a focus.
But when you say asset classes, are they going to be debt specific only? Is Wint always going to be about debt, or do we see you doing a bunch of other things as well?
No. The white space we are attacking it somewhere between FD and equity, right? So
right.
That's that. Our products will be always somewhere there. Even the new asset classes will be always there, right? We don't want to really go broad. We would like to go deep and bring in more asset classes with the same value proposition.
Interesting. Ajinkya, my last question, right? Again, a cliched one. I'm sure you answered this on many occasions, but I can't not ask you this question, right? A founder is always grappling with just too many aspects around his or her business, right? And that, I believe, is always a learning which can be passed on to many others, right? And my sense is a lot of founders are going to be watching this, right? Especially the fintech founders, right? And I think that's the word which is exciting many people, right? The ones who are in core fintech and the ones who are at very interesting intersections, right, of other industries and fintech kind of now coming together. What would that one word of advice be, right? Given that you've been pretty much across the spectrum, right? You built this, you're handling money. You're basically creating for something that did not necessarily exist in the form and way that possibly does. What would that advice be?
I'm not the best person to give this advice, but let me tell you the advice I got and which is
Sure.
pretty relevant for me. As a startup, our first job is to make a machine that works.
Right.
And then the next part of CEO's role or founder's role is to make a machine that makes such machine. So, from, let's say, replicating that success again and again through a process-oriented, team-oriented, very process-oriented game is very important for us. We have done decent in the first leg, but
Right.
to make this long term, we need to repeatedly show that game and deliver results, right? And it has to be process driven, and that's what we are focused on, I think. Let's see how it goes, but that's the advice I got, and I really am focused on that.
Interesting, and that's possibly the advice that you want to pass on to many others, right?
Yeah, absolutely.
Is what I'm assuming. Ajinkya, it was a pleasure to have you with us. Thank you so much for taking the time out. How I, again, cliche, right? But how I wish these conversations could go on, because there are just many aspects that we can discuss, right? And India is not a market which is a simple market, right? I think we're by far one of the most complex markets, right? With a lot of regionality, a lot of behavioral tendencies, a lot of risk, for example, right, on the investor side varies pretty much like the food that we eat across all regions, right? But I think all of that is coming together. I think the way you're solving it, I think what's heartening to see is that there's always a need for somebody to come in and take that purest call of wanting to solve for India, right? And that requires for a lot of patience, plowing that market with a lot of effort, factoring in a lot of those things. And I think that's something which is visible, in the way you kind of doing it, right? I think it needs to be given that kind of time, right? Products that'll possibly get built in rush will land up becoming bad apples, right? For many others, and that could have a negative rub off on the entire overall industry, right? And I think a bad word for startups which are in the money management space, right? But like I said, right, it's heartening to see what you're doing and the sincerity with which you're kind of approaching it. There are certain things that are visible. There are certain things that will have to be worked upon. Risks, for example, industry risks, macroeconomic risks will have to be readjusted for. But I think all of that is work in progress, right? There are no clear answers. Ajinkya, like I said, thank you so much. It was a pleasure to have you with us. Look forward to having you with us much sooner, having very specific, detailed discussions. One thing that I want to, of course, would love to discuss with you is how is tier 2 and tier 3 coming along, right? And that we're going to cover in the next conversation. Thank you so much.
Yeah, look forward to that conversation, Ashu. Thanks for having me. I really enjoyed this conversation. Thank you.
Thanks.